The wash sale rule is an IRS regulation designed to prevent investors from claiming tax losses on investments they didn't truly give up. It is called a wash sale because the transaction effectively washes away the tax benefit while you keep the same investment position. The rule triggers if you sell a security at a loss and buy a substantially identical one within 30 days before or after the sale. When a wash sale occurs, you cannot claim that loss on your current tax return. Instead, the cost is added to your new shares. The main difference is the timing. If you want to harvest a tax loss, you must wait at least 31 days to repurchase. This chart shows the immediate impact on your deductible losses. A wash sale reduces your current deduction to zero, deferring the benefit indefinitely. Be careful, because the IRS looks at all your accounts. Selling in a brokerage and buying in an IRA still triggers the rule. Understanding these rules can help you manage your tax liability more effectively. This is educational content, not financial advice. Consult your tax professional.